This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, this is the last lecture on Chapter 7, the variances. And I said in the previous one, we've ended up doing all the variances and preparing an operating statement, but on the basis that they've been using marginal costing. They could, though, have been using absorption costing. And so we're going to do the same exercise again, exercise 1, but don't worry, it won't take that long because, as I said before, it's only a couple of things that change. Before I do, because as I said right at the very beginning of all of this, although you can and you must learn the rules, I think it's terribly dangerous to learn rules without understanding. I'm just going to do two things before we look at the variances themselves, just hopefully to make the whole thing clear. The first is exercise 1. Let's rewrite the cost card using absorption costing. Materials, same question. So as before, 18 is 4 kilos at 4.50. Labour, I won't show the analysis, but it's 5 hours at $5 is 25. Variable overheads, 5 hours at 2 is 10. So I won't total here, but there's the marginal cost. If we're using absorption costing, we bring in the fixed overheads. Now then, probably, for the full answer, they'll have been absorbed on an hourly basis. So let's work out the absorption rate. The total overheads were 130,500. If we're going to absorb them on the basis of labour hours, we'll divide by the total budgeted labour hours. And we're doing the cost card, so we're basing all this on budget figures. So we budgeted 130,500. The hours, we were budgeting on producing 8,700 units and taking, where is it? 5 hours a unit. And so we're budgeting on 43,500 hours. So the overhead absorption rate is 130,500 over 43,500. It's how much per hour? That's nice, $3 per hour. And so if they're absorbing on the basis of labour hours, the fixed overheads, each unit was taking 5 hours of labour, and therefore at $3 per hour, it would be 15 a unit. So the absorption cost, the full cost, 18, 25, 10, 15, is 68. The selling price is the same question, remember. The standard selling price was 75. So the standard profit, 75 selling price, 68 cost, a standard profit of 75 less 68. My head's going funny. Is that 17? No, 7. What am I talking about? $7 per unit. So a bit of easy revision from chapter 1. But it's absorption costing. There we are. And so finally for this little bit, the first of the two things I want to do, what would be our original budget profit? The original budget, we budgeted on selling 8,000 units. at a profit of $7 a unit is 56,000. All right, now this is still actually a revision of chapter 1. This is absorption costing, and the budgeted profit was 56,000. If you look back, oh, good if I didn't rub it out. When we did marginal costing, we were budgeting on a profit of 45,500. Why different? Now this has nothing at all to do with variances. Sorry, I'm not wasting your time. I needed to do that. But while it's there, I'd be silly not to mention, why are the two profits different? Well, again, it's back to chapter 1. Go back to chapter 1 if you need. Absorption marginal will give different profits. Not a variance problem at all. They'll give different profits because of the way inventory is valued. The difference, if you remember, is the change in the inventory. And on budget, which is what we're looking at, opening inventory was 0, closing inventory was 700, so inventory changed by 700 units. It's the change in inventory times the fixed overhead per unit, which is 15. And so you'd expect the profits to be 10,500 different. And are they? Yes, they are. So I say that bit's not a variance problem at all. And you certainly won't be doing variances both ways in the same question. But we said back in chapter 1, you can certainly be tested on that, that marginal absorption will give different profits. Anyway, back to where we were. I said there were two things I wanted to do. That's the first. We've done our cost card. We know what the original budget profit was. Let's just quickly work out what the actual profit turned out to be. Again, using absorption. And again, you won't be doing this in the exam, but I've told you, like it or not, it is important you understand. It's not just a rule thing. So let's just set up an actual profit statement. On the actual results, the revenue, 613,200. The cost of sales, well, we take the cost of production first, and the materials, 163,455. The labour, 224,515. The variable overheads, 87,348. The fixed overheads, we're using marginal, remember, so we're not messing around with contribution here. So the actual fixed overheads, 134,074. So the total cost of the 8,900 we produced is no, that can't be right. Yes, it can. I've rubbed it out. Oh, 163,455 plus 224,515, 87,348, 134,074. Oh, I am sorry. Be patient with me. 163,455, 224,515, 87,348, 134,074. 609,392. That's the cost of the 8,900 we actually produced. To get the cost of the 8,400 we sold, subtract the closing inventory. There are 500 units inventory. And as I said when we did marginal, we always, in variance questions, we always value inventory at standard cost. But since we're using absorption costing, the inventory, the standard cost is $68 a unit. So 500 at 68 is 34,000, giving us a cost of sales of 575,392, and a profit, therefore, it's decided it doesn't want to wind back anymore. Anyway, yeah, revenue 613,200 less 575,392, an actual profit of 37,808. Which again, different from marginal. Let's not mess around with the marginal anymore. But the difference from marginal will be the change in inventory, 500 units times the fixed overheads. The standard fixed overhead of 15. It'll be 7,500 different. Anyway, let's now go straight into our operating statement. We know what our budget profit was. It's 56,000. So operating statement. Absorption costing. As always, we start with our budget profit. And this time it's 56,000. Just like before, we're going to list all the variances to explain why the actual profit is different. And as you'll see, there are two differences, and I'll put an asterisk against them. But the first variance we look at, the most obvious one of all, is the sales volume variance. And the sales volume variance, just like we did last time, we say, well, how many units did we sell? 8,400. How many units did we budget on selling? 8,000. We've sold 400 more units. However, when we're using absorption costing, we say, well, how much extra profit do we expect from those units? We multiply by the standard profit. And the standard profit we worked out a moment ago, $7 a unit. And so if you sell 400 more units, you'd expect profit to go up by $7 a unit, an extra 2,800. And there is our first difference. With marginal, we looked at standard contribution unit. With absorption, the volume variance, we do it at standard profit per unit. We then carry on as before, and the rest of it, with one exception, is just as it was for marginal. So I'm not going to do all the workings again. But we had a sales price variance. Last time it was 16,800, and exactly the same workings. Again, I'm not going to repeat the workings, that'll be silly. But you know, if you reduce the price by $1, you have $1 less profit. Doesn't matter whether you're doing absorption or marginal. So sales price variance, the workings are always the same. So as before, it's 16,800 adverse. We then had our cost variances. Materials. We had an expenditure or price variance of 3,867 adverse. And again, exactly as before, if you spend more on materials, you've less profit. It doesn't make any difference whether it's marginal absorption. We had a materials usage variance of 612 favourable. We had a labour rate variance of 2485 favourable. We had a labour idle time of 6500 adverse. We had a labour efficiency variance of Was it 2,000? Yes, it was 2,000 adverse. A variable overhead variance. Expenditure was 852 favourable. Efficiency variance 800 favourable. So all of those as before. Once you've learnt those variances, it makes no difference whether it's absorption or marginal. So far, sales volume, I think that's an easy one to remember. It's always the difference in units, actual and budget. If it's marginal, it's a contribution per unit. If it's absorption, it's a profit per unit. However, the other change, fixed overheads. It starts off okay. Fixed overheads, remember, should stay fixed. And so, when we looked at the expenditure variance using marginal costing, we simply looked at the difference between the actual total and the budget total, the expenditure variance. The difference between the two was 3,574. And again, whether it's marginal or absorption, if you spend more, obviously you've made less profit. However, there is one extra little problem when we're doing absorption. And I'll try and explain, although ultimately a rule's a rule, and it should really be a revision of what you've done earlier anyway. But when we did the sales volume variance, we used standard profit per unit, $7. Which is easy. I think it's easy to remember and it seems sensible. But in fact, if you think about it, there's a little problem. And the little problem is that the $7 a unit assumed fixed overheads were $15 a unit. And fixed overheads are only $15 a unit if we produce the budgeted quantity. Because we worked out the 15, but by saying it was $3 an hour. And the hours, we were assuming that we produced 8,700, the budgeted amount. Well, we didn't. We actually produced 8,900. And if we produce 8,900, in fact, the fixed overheads don't turn out to be $15 a unit, and the profit isn't going to be $7. Using $7 as a volume variance is assuming fixed overheads stay at $15 a unit, and as I said, effectively they don't. And so I hope that made some sort of sense, but this one really you're going to have to learn. But to correct it, to allow for that, we've got an extra variance, and it's called the volume variance. And rather than squash the workings, just let me show you how we calculate it. To calculate the volume variance for fixed overheads, we compare the actual production. We actually produced here 8,900 units. With the budget production, we budgeted on producing 8,700 units. And we cost it out at the standard cost per unit. For fixed overheads, obviously, it's fixed overheads we're dealing with. So the standard cost per unit was $15. If you look back at the cost card, it's 3,000. Now, I'm not going to waste more of your time explaining the logic. I gave you the logic, but in fact, what we do in a minute will prove that it works. Just one problem, though, a very common problem. People can't decide, oh, is it favourable, is it adverse? All of the others we can make mistakes on when you're rushing, but you know, it's obvious you spent more, you spent less, and so on. With the volume variance, it isn't quite as obvious. Well, this here is favourable, and the strict reason is, think about it, if you produce more, the fixed overheads per unit strictly should be less. And if the cost per unit is less, profit's higher. I'm not sure I can always think that through in the middle of an exam. So what I say, and it always works, I just say if we manage to produce more, that's good. If we produce less, it's bad. It's up to you. Anyway, we produce more. Good, it's favourable. So the volume variance, 3,000. And let's check it does work. The net of all of those should be the actual profit, which we worked out earlier, so I have something to check to. Budget 56,000. 2,800 favourable, 16,800 adverse, 3,867 adverse, 612 favourable, 2,485 favourable, 6,500 adverse, 2,000 adverse, 852, 800, 3,574, 3,000. I get the wrong figure. It's very annoying, but still. 56,000. 2,800 minus 6,800 minus 3,667 plus 612 plus 2,485 6,500. And I realised, I'm sorry, I don't know if any of you noticed, that efficiency variance was in fact favourable. I wrote it down as adverse. So plus 2,000 plus 8 plus 37,808. I am sorry about that. But 37,808, and that it does sort of check, yes, there is the profit we'd worked out. So it is correct. So it's those two things. You know, I said earlier, you will not be doing a profit statement. I've done it to hopefully explain. But the only two differences in marginal and absorption variances are the sales volume and the fixed overhead volume variance. Now with marginal, that variance doesn't exist. With absorption, it does exist. All right, I'd love to stop there, but I'm afraid, to be safe, there's one more thing we need to do, which I always think is slightly silly myself, but for completeness I need to do it. It's back again to that volume variance. The volume variance occurred because we produced more units than we budgeted on doing. Why did we produce more units? Now, in fact, there are lots and lots of reasons why it may be the case. Maybe just we decided to produce more because we were selling more. But another reason could be this. When we did our budget, we budgeted on producing 8,700 units. Why didn't we budget on producing more? maybe we could only produce 8,700 because we only had enough labour to produce 8,700. And if that was the case, how have we managed to produce more? Two ways. Either we've managed to get more labour than I expected. If you get more workers, you can make more units. Or our workers worked faster. If our workers work faster, then in the same hours, we can make more units. The reason I'm saying that is, although I think it's, maybe I'm being unfair, a bit silly, you can be asked to analyse the volume variance. Analysis of the fixed overhead volume variance. So the volume variance is 3,000. We're going to split it and say, why did that occur? And I told you, we're going to look at the labour hours and see, did we have more hours than we expected, therefore we could make more units? Did we work faster than we expected, therefore we could make more units? And the analysis, the first one we call the capacity variance. And for capacity, here we're looking to see, did we get more working hours than we expected or not? So how many working hours did we get? Well, the actual working hours were 44,100. How many hours did we expect to be available? What were the budgeted working hours? Well, in our original budget, remember, we thought we'd produce 8,700. We budgeted each unit would take 5 hours. And so we budgeted on 43,500 hours. And so we actually got more hours from our workers than we thought we'd get. We got an extra 600 hours. And we cost it out at standard cost per hour. Remember, it's fixed overheads we're doing, so the standard cost per hour for fixed overheads, which if you look back, we'd absorbed it at $3 per hour. There's the variance. Is it, sorry, I called it capacity hours. I should have written capacity variance. However, there's the variance. But again, though, it's not always obvious to everybody, is it favourable, is it adverse? If you've been listening to the way I was speaking, that's the way I remember it. We've got more, we ended up with more working hours than we expected we would. And if we get more working hours, we can produce more units. Therefore, it's favourable. And the very, very last of all, I said there were 2 reasons why we managed to make more units. Either we had got more working hours than we expected, that's what that is. Or the other way is if our workers worked faster than we expected. If they work faster, we can make more units. So the remainder of the analysis is the efficiency variance. And this is actually a very easy one to remember. Let me write the rule down and then tell you why it's easy to remember. To see whether they're working faster or slower, we take the actual hours worked, 44,100, and we compare it with the standard hours for the actual production. How many hours should they have worked for our production? We produced 8,900 at 5 hours a unit. You would have expected them to work 44,500. They worked faster, 500 hours faster. Again, because it's fixed overheads we're looking at, we cost it out at the standard fixed overhead cost per hour, which is $3. Total 1,500. And I can't do it my arithmetic. I'm a disaster here. 5 minus 1, it's 400 hours faster. It comes to 1,200. And again, favourable adverse is perhaps more obvious anyway. Here, they're working faster than we expected. Therefore, it's favourable. And two things. One is, I said we were analysing the volume variance. The volume variance was 3,000, if you look back. We've now analysed it into those two, 1,800, 1,200, total 3,000. And finally, the efficiency variance, in fact, is very easy to remember. Because if you look back, it's exactly the same workings as labour efficiency, variable overhead efficiency, for the same reasons. If you look back, labour efficiency, we had the 400 hours, but we costed out at the labour rate per hour of $5. It was 2,000. For variable overheads, again, we had 400 hours. We costed it out at the variable overhead per hour of $2, and we got 800. Anyway, there we are. So that was all the basic variances. If you already remembered it all perfectly, then I'm sorry if you fell asleep. Otherwise, there we are. Make sure you are happy with them, though, not simply because they can be tested in their own right, but in the next chapter where we look at the advanced variances. Don't be frightened, they're not hard. It won't take as long, in fact, as this took. But if you're happy with basic variances, the advanced ones are relatively straightforward. If you're not happy with the basic ones, well, it makes the advanced ones a bit of a mess. Okay. Anyway, go and practice the. You know about I mentioned before these practice tests linked from the main P1 page. If you think you've got it, have a practice a few questions. Good.